So, ladies and gentlemen, dear colleagues, I would like, of course, to welcome you on behalf of the Executive Committee, who is now in a meeting, on the behalf also of our partners, BRS and SERA, as you know, our main shareholders, ADA, Assuralia and Febelfin. So please feel at home here. The second thing is, of course, to say again that we attach as KBC great importance to microfinance and especially to the fact that we are together involved in it. I think the subject of today is a very interesting one. We took, I think, the last two sessions more the banking side. As we are a bank insurance group, you are discussing now the insurance side, and of course I will not dwell upon it because we have nice introductions. But again, certainly after the financial crisis, we as a financial institution, we are aware of our responsibility in general and our social responsibility in particular. And the third point I wanted to mention is the fact that I have unfortunately to leave your meeting so that I cannot hear probably the entire conference of the speaker, and I want to apologize, and I did already so with Mr. Churchill, that I will probably read his introduction, but I will only hear half of it. This having been said, I wish you a very pleasant conference and a very interesting one. Thank you.
Ladies and gentlemen, as a representative of Assuralia, the Belgian Insurance Companies Association, it is my honor and my pleasure to introduce today's lecture by Craig Churchill. I'm particularly pleased to stand in front of you, as I was raised in a family with a very strong Raiffeisen background, and all things come to a circle. You get back in familiar surroundings when dealing with issues that relate not to mainstream insurance, but in this case with micro-insurance. And the title that came to my mind when thinking about the issues that were raised by micro-insurance was a pun on a 1985 hit song by Grace Jones. I would use the title, Slave to the Risk. Slave to the risk because when thinking about micro-insurance, the idea comes naturally to your mind that insurance is a kind of liberation, can be a tool of emancipation. Scholars who have been studying the very word risk, which is at the core of the insurance industry, of the insurance business, have rightly indicated that the word risk is of Arabic origin and came from the western part of the Mediterranean, from the southern shore to the northern shore of the western Mediterranean, at the time when the people were busy to envisage and to design the contours of insurance as we know it today. Insurance as a combination of financial capacity, knowledge of occurrence, and prevention, all brought together in mutuality. And I guess those are ideas that find a very strong echo in the work of Craig Churchill. The word risk, as it appears in the Arabic language, as it appears also in the Holy Quran, has a meaning of one's fortune, one's chance, one's fate. And the question comes to mind whether risk should be destiny, whether destiny of mankind should be risk, or whether it is possible to emancipate oneself from the gods throwing of the dice. The understanding of risk in a modern sense has led to the creation of insurance, which was born in a world of merchant adventurers in order to provide safety against the unknown in their marine enterprises. Belgian cities like Bruges and Antwerp were breeding places for insurance as we know it today, and the customs of our trading metropolises of the day still imprints our industry. It was a top-down story. It came from a business-to-business relationship and went on to provide safety and security to the teeming masses, like one would say in the United States. Insurance has gradually spread from marine insurance to include life insurance, property insurance, liability insurance, and of course automobile insurance. Many people in all countries are still not familiar with what makes the difference between sheer solidarity that has a much older history than insurance itself and insurance as it is organized through the payment of premiums, making sure financial capacity is around, establishing reserves, and meeting claims in due time. But as the case of tribal solidarity shows, and even as the case of the mutual help that you will find in communities like the Amish community when they have to raise a new barn, it doesn't offer full protection in all cases, and too often these basic forms of solidarity may fail. Family ties will certainly have a social value with which insurance has to take account, but insurance will be able to overcome a number of limitations that you will find in what family ties or other informal solidarities may provide. But insurance does not always come free. In most cases it won't at all, and in those cases where budgets are limited, it will probably be better to concentrate the expense on key persons or critical functions. In his post-crisis book on financial markets, Nobel Prize winner Joseph Stiglitz underlines that for markets to perform ideally, insurance should be available against all uncertainties in order for any economic choice to reflect the true cost of opportunities and threats. To this day, insurance is framed by the limits of insurability, including the affordability of insurance, and efforts to extend what is insurable are a factor of both economic and social progress. Extending the reach of insurance indeed appears to be an effective tool to fight poverty and vulnerability, but it will require adaptation to the scale of microinsurance operations. It will be a learning process in which both parties have to be in listening mode, as acculturation is a two-way street, whereas the one-way street some may have in mind would be the insurance equivalent of post-imperialism. The track record of Belgian insurers in extending the reach of insurance on their home market is probably impressive. Belgian insurers have also served abroad to make their knowledge available on business terms as well as through charities. Close neighbors have pioneered in health insurance for truck drivers or market makers in the markets of Nigeria, or providing flood cover for the outskirts of Jakarta. Microinsurance indeed holds the promise to bring insurance to parts other means cannot reach. The analysis of threats and opportunities will most certainly result in a specific product development track for microinsurance. Distribution will also be a challenge, but may hold lessons for the developed world too, as might product design based on the ease of understanding something or sophisticated models do not always excel in. Therefore, Assuralia is very happy to associate with the initiatives of the Belgian Raiffeisen Foundation and of ADA, who testify that microfinance is one axis of development, but that microinsurance is another key resource in helping those at the bottom of the ladder, near and far, to emancipate themselves. In this European year of fighting poverty and social exclusion, we wish the BRS Microinsurance Lunches the best of luck. We today have Craig Churchill as our speaker, and I was asked to introduce Craig to you today. I was not aware how easy it was to come across Craig's work. When you start Googling about microinsurance, the first thing you will encounter will be the works of Craig Churchill. And then came across my desk the anniversary copy of the French insurance economics magazine Risque, edited by Jean-Hervé Lorenzi. And well, there was a piece about microinsurance, and who would you encounter in that piece but Craig Churchill? Craig Churchill is leading the International Labour Organization's social finance program. He is in charge of the Microinsurance Network and on the editorial board of the Microbanking Bulletin. He has launched the Microinsurance Innovation Initiative as a partnership with the Bill and Melinda Gates Foundation. And I guess he's the most qualified person probably in the world to tell us about the developments he sees for microinsurance. Craig, the chair is yours.
Good afternoon, everyone. Thank you for that very powerful introduction. It was great. I mean, not the part about me, but the part about the historical evolution of insurance is really quite relevant as far as microinsurance is concerned. So you start thinking, why are we talking about what happened 2,000 years ago? Well, a lot of the things that are involved in the provision of insurance to the poor are essentially relevant from the historical roots of insurance. Less the marine part, but much more the solidarity and say the industrial insurance from a couple of hundred years ago, where the insurance industry essentially tried to make itself relevant for the low-income households, workers, collecting premiums at the factory gates and so forth. So many of the discussions that we have about insurance for low-income households are essentially back to basics campaigns. How can we get insurers to get back to their roots, and whether it's their cooperative and mutual roots, or whether it's thinking about risk and how insurance can help people manage risks as a way of making the insurance industry relevant again for the majority of the population. This is particularly in developing countries that we're talking about, where insurers may have maybe serving 5% of the households in the economy. So there's 95% of people who don't have access to insurance. And so when we talk about microinsurance, it's really trying to find a way of making the insurance industry relevant for the majority of the population. So I want to thank the organizers, BRS and the other organizers for introducing me and inviting me to come here. It's certainly a great opportunity and an honor to be here. It's a lovely venue. So I feel like it's great to have the chance to inaugurate it for you. So I appreciate that. And I'm going to, in the next 20-25 minutes, try to give you a quick intro to microinsurance that will probably raise more questions than provide answers. But hopefully then we can move into a question and answer period where we can try to come up with some of the answers as well. So how many people here work in the insurance industry? Just a show of hands would be useful. Okay, so there's a fair number of people. So maybe I'd be interested to know whether you would be interested in insuring these households. What about these farmers? Would you provide coverage for their farms? What about these assets? Often cows, camels, pigs, these are the primary assets that low-income people have, particularly in rural areas. If they lose those assets, they've lost their major source of income and their major assets. Would you insure these lives or the health of these people? So this is basically what microinsurance is about. I'm just sort of giving you a few visuals to try to make it a little bit more real and see who is it that we're talking about insuring. So today I want to cover three things. I want to give a little bit of background on microinsurance, trends that we're seeing, some examples of innovation, and some key challenges, and just sort of wrap up with some of the key challenges. So what is microinsurance? Well, a couple of years ago, the IAIS, the International Association of Insurance Supervisors, put together an issues paper on insurance, and this is how microinsurance, and this is how they've defined it. It's not a specific product line, and it's not limited to a specific provider type, but it's to cover for a specific market segment, low-income persons. Now, trying to probe a bit on what is low-income persons, how low do you have to be low income, are things that microinsurance is still getting at and grappling with. But I think the key part here is that there's a lot of different types of products. We're not talking about health or life. We're talking about a range of things. We're not talking about any particular type of institution. It could be an insurance company. It could be a community-based organization. It could be a mutual. And the other key thing that's here is the IIS itself. And the fact that the global standard-setting body for insurance is actually talking about insurance for the poor is a pretty phenomenal activity or resolution. And so they're providing significant leadership in this area, primarily because many of their members are insurance supervisors in developing countries, and the IIS, based in Basel, is trying to make itself relevant for the markets that they're operating in. So why are we talking about this? Well, I'm talking about it from the International Labour Organization, which is where employers and workers and governments get together to talk about issues related to the world of work. Many workers are vulnerable to risk, and when those risks might be injuries at work, it may be death, it may be illness, it may be disasters. and those things reinforce poverty. Now, a lot of the development agenda is really focused on how to help people increase their incomes, how to create employment, and there needs to be, I think, a complementary initiative to be able to think about risk and risk management, because any efforts to, say, through microfinance to help small businesses to grow, those gains in income or employment can quickly be lost as soon as the entrepreneur or workers in that business end up getting sick or key breadwinners dying, for example. So we can't just focus on efforts to stimulate growth and income, but also need to think about the safety net side and the risk management side as well. And so we see microinsurance as a natural complement to efforts to boost incomes and create employment. So where does microinsurance come from? So it has a variety of different roots, and this is why it's quite interesting to have conversations with people about microinsurance, because they may be coming at it from one of the many different roots that it has, and so they may have a different image than the people that they're speaking to. So one of the roots is microfinance. Microfinance, as many of you know, if you came to the other midi luncheons, has evolved in a variety of different places, and it is primarily has been driven by loans to micro-entrepreneurs, but is now expanding to think about more financial inclusion issues. And financial inclusion is provision of broader financial services to low-income households. And one of those services could be insurance. And so a part of the microinsurance discourse has evolved from microfinance, where microfinance institutions who are providing loans, maybe savings, said, maybe we could also provide insurance as well. And so they started experimenting and trying to figure out how to do that. Another source of microinsurance, and perhaps it does predate the microfinance discourse, has been from cooperatives, particularly savings and credit cooperatives, who've been offering insurance to their members for many, many years. They didn't call it microinsurance. The terminology's only been around for the past decade or so. But essentially, they're providing insurance cover and risk management protection to low-income households. Now, they weren't focusing exclusively on the poor, but that doesn't matter. At least they were finding a way of extending coverage to the poor. Another sort of root cause or root of the microinsurance industry is the extension of social protection, where organizations like the ILO and others said, well, you know what? There's all these social protection initiatives that are providing protection to workers in the formal economy, but if the formal economy only employs 10, 20% of the workforce, what are we going to do about the other 80, 90%? And so there have been efforts, particularly within the health field, particularly health mutuals, to be able to extend social protection coverage to workers outside the formal economy as a way of making sure that they have access to similar types of social protection benefits as workers in the formal economy. So that's another root of microinsurance, has been particularly these health mutuals that have been quite common, particularly in West Africa. And then the fourth root that I want to talk about is BOP strategy for insurers. So BOP means the bottom of the pyramid. This was an approach that was promoted by an academic named Prahalad, who wrote a book called The Fortune at the Bottom of the Pyramid. And so now BOP is a common term for this market-placed approach or market-driven approach to be able to provide services to low-income households and sort of help them be better off at the same time while generating profits for industry. And a lot of the analysis that he looked at was how to package shampoos and other services so that people who only have a little bit of income can buy a packet of shampoo instead of a whole bottle of shampoo, for example. So the same principles can be applied to banking. So microfinance is essentially a BOP strategy for savings and credit. And now insurers are also seeing this as something that's quite relevant for them. And they do that because it's quite appropriate for insurance. With loans, with lenders, and they're giving loans to low-income people, they're taking the risk. And so banks have been sort of standoffish with regard to microfinance to some extent. Whereas with insurance is driven around this concept of the law of large numbers, easy for me to say. You say that 5 times fast. Where if you have large numbers of insured, then your claims experience will be much easier to predict what your claims experience is going to be. And so because of that, this idea of being able to provide insurers with large numbers of low-income people on a silver platter is quite attractive to them. So the silver platter concept, the delivery bit, is one of the major challenges that we're gonna get to. And I'm going to have to pick up the pace here because we're running behind schedule. Anyway, so these are the four main routes. There's some others, but these are the different ways that people might have gotten into the discussion around microinsurance. So why is microinsurance different? Just quickly, if you think about this target group, maybe they can't read the policy document, maybe they don't have a national identity document, or maybe they don't have a birth certificate, maybe they can't afford to pay premiums every month because they have very irregular incomes, so perhaps it's based on agricultural cycles or so forth. Maybe they don't even have a bank account, so the idea of being able to automatically deduct premiums for their bank account is not an option. If the medical exam for this person is more than the sum insured of the life insurance policy, that's not a very effective screening mechanism. Maybe they don't have legal title to their home, so being able to provide property insurance for their homes then creates a challenge if they don't have legal title. Maybe their next of kin, if they die, would not be easily able to access a death certificate. Maybe if they wanted health insurance, but the nearest healthcare facility is 50 kilometers away, that would create another issue. And maybe they don't trust insurance companies. So this is just a quick laundry list of many of the different reasons why we can't just take insurance as it's currently structured and say, here, let's lop off a few zeros off the end of the sum assured and the premium and say it's microinsurance. Instead, we have to sort of completely redesign the product in order to make it relevant for this market. Because of these and many other characteristics, it's a very different market to serve. It's not the market that insurers are used to serving, so we need to figure out how to completely adapt the product to this market segment. So we did a survey. You probably can't read this, but I'll tell you what it says. We did a survey in Africa last year to see what was the extent of microinsurance in the region. And the first column on the left is credit life, where there were, it looks like 8 million people covered. The next was other life insurance, funeral insurance, property, personal accident insurance, and there was a little over 9 million. So that's 17 million of the... Oh, so there's double counting, so that's why there's 14 or almost 15 million covered, but some will have multiple policies. But you see in the sort of the credit life and other life insurance, and most of the other life insurance, in fact, comes from South Africa itself, where there's a huge uptake of funeral insurance. For social and cultural reasons, people have a keen interest in having appropriate funerals, and so there's a big demand for funeral insurance. But the other sort of categories, health, agriculture, other property, there's very little availability of insurance. And this is interesting because when you go out and you do demand research and you talk to people about the risks that they're vulnerable to and the ways that they manage those risks and the things that they're most concerned about, the things that keep them up at night, makes it difficult for them to sleep, risks related to agriculture and health are certainly high on the priority list. But unfortunately, when you looked at the supply side, those are the types of coverage that are least available. So the ones that are, and it's not surprising, I mean, the things that are the easiest to do, life insurance related to loans, are the things that are most widely available, and the things that people really want the most are the least available. And so this is sort of the big challenge in microinsurance, is how to design and develop better products for more low-income people that really meet their needs, really meet their risk management concerns. So I want to talk about some trends that we're seeing in microinsurance. As Mr. Robyns said, I head up the ILO's Microinsurance Innovation Facility. And here we are providing support to some 45 microinsurers around the world who are doing innovative things. And we've selected them through a competitive process of applying to us for grants. And so because of that, we're in a position to really see a lot of the innovative ideas that are out there and see who's trying to do what, and have identified some interesting trends that are emerging. One is that insurance companies are increasingly interested in serving the low-income households. This is the BOP concept. It could be. So what is their motivation? Sometimes it's just corporate social responsibility. They say, well, we have to do CSR. We might as well do it sort of close to our core competencies. So let's test out this microinsurance thing. What we're trying to do is to say that's a nice start maybe, but we want them to take the market much more seriously and find ways of serving it in a profitable way. But for example, we're giving support to Zurich, which is a multinational insurance company. Allianz is one of our grantees. You think, why would the ILO give a grant to Zurich or Allianz? That seems very strange. It's because we think that they're testing things that will enable us to learn from their experiences and then to be able to share those experiences with others. So a small investment to give us a seat at the table to be able to monitor their progress and their innovations enables us to learn from their experiences and make sure that others have the benefit of learning from them as well. Otherwise, Zurich and Allianz would go around doing their own business and not tell anybody about it, and so there wouldn't be this multiplier effect of being able to learn from their experiences. Another thing that's really interesting is that microinsurance is really emerging from the shadow of microfinance. And so if people in the room here come from a microfinance background, your initial thought is, well, microinsurance is just another product that microfinance institutions can offer, and that's true. But if you step back and you say, you know what, I'm actually going to look at microfinance from a microinsurance perspective and say, microfinance institutions are just one way that I can get insurance to low-income people, but there's actually lots of other ways that I can extend insurance to the poor. That's a pretty dramatic change in perspective because microfinance institutions have fairly limited outreach, I don't know, 150, 180 million, something like that. And there's several billion low-income people who might benefit from insurance if we could find other delivery channels of getting insurance to them. So the fact that microinsurance is emerging out of the shadow of microfinance, I think, is a fascinating development. And one key piece of that is this distribution channel, and that microinsurance is being distributed through a variety of different ways, not just through microfinance institutions, but through cooperatives, through retailers, through utility companies, through cell phones. So the potential for distribution is the potential of reaching very large numbers of low-income people is increasing dramatically because of the emergence of new distribution channels. Another key trend is around consumer education. One of the obstacles in providing insurance to low-income people is the fact that they often don't understand insurance or they don't trust insurance. And so there's a big effort that needs to be made on consumer education, insurance awareness, and there are a fair number of experimentations going on now to be able to provide that. And the question is really, who should be responsible for that? Should it be the insurers? Should it be the government? Should it be insurance association? And we're experimenting with different approaches to try to see which ends up being the most effective. Some other trends. I mentioned this already, that the fact that the policymakers are getting involved in microinsurance is a huge boost, and it's quickly outstripping the engagement of banking regulators, which have been sort of less enthusiastic about microfinance, whereas the IAIS is quite keen. And together we've launched this Access to Insurance initiative. So this is driven by the IAIS with CGAP, the ILO, German government, and Finnmark Trust from South Africa as a way of providing support to insurance supervisors who are interested in creating an enabling environment for microinsurance in their country. That's the Access to Insurance initiative. I think another thing is recognition that there are limits to this BOP business model, and it's particularly related to health and agriculture. That sort of a market-based approach are not going to solve all the problems. In fact, insurance isn't going to solve all the problems to begin with. We need to be very careful not to be overselling the importance of insurance. It's one of the risk management tools that need to be in place, but it's certainly not going to be a magic bullet. But even within insurance, I think there's a recognition that this market-based approach will have limited scope for it, particularly with regard to health and to some extent with agriculture as well. And so what we're seeing is greater number of public-private partnerships where governments and private sector are working together, and governments providing some subsidies to cover some of the premium expenses. And so we think that has great potential for for extending coverage to more low-income people. And then the last trend I want to mention is the fact that there are product innovations taking place to make insurance coverage more valuable to the poor, and I want to give you a few examples of those. What we see here is a bit of an evolution that in many countries microinsurance is really sort of linked to credit, very simple life insurance, and where you get some experience with that, maybe there'll be a chance to leap to the next phase, which would be greater sophistication, thinking about new delivery channels, starting to provide the market with choice so that they don't have to just take what's offered, but they can start getting different options available to them. And then the last phase is where some countries, particularly India, are with a lot of experimentation, innovation taking place in India, where you get more complex products, you get composite products that provide coverage for different risks, greater use of technology, different engagement with other types of partners, including hospitals, government, phone operators, and so forth. So let me just try to quickly give you a sense of some of the innovations that we're seeing. These are organizations that have we've provided grants to, who are testing to see how they can provide better insurance coverage to more low-income people. This is around distribution channels. So La Positiva is an insurance company in Peru, and they said, we can't reach rural areas very effectively, so we're going to collaborate with these water boards, which are where farmers get their water from through these rural water cooperatives, because they could be a mechanism for collecting premiums. When the people pay for their water bills, they can also pay for their insurance. So this collaboration with these water boards is a way of extending insurance to people who otherwise they wouldn't be able to reach. These are people who don't have access to microfinance necessarily. Hollard in South Africa is offering a property insurance product. As I mentioned before, funeral insurance in South Africa, there's a huge demand for, and Hollard has got a big chunk of that market, and they've been distributing that insurance through retailers. So the place where you might go to buy your clothes or your food, you can also buy your insurance. You can buy it off the shelf, a little pack that's for your funeral insurance. So now Hollard is experimenting with this next generation that, can people who have good experience with funeral insurance see that perhaps there's other risks that they might want to cover, and now they're experimenting with a property insurance product. Pioneer is an insurance company in the Philippines, and they're distributing insurance to families, to groups of families through churches and schools. And these are families of migrant workers. So the migrant workers are sending home lots of money, and some of that money could be set aside to pay for premiums, including savings as well. So this is a life insurance that has a savings component that allows people to be able to save money and to cover risk at the same time. So the engagement with some of these distribution channels is where low-income people are going to have a trust already. Churches is a good example that presumably you would be trusting your church, particularly in the Philippines, which is a very strongly religious country. And so you're leveraging that trust factor. So maybe Pioneer itself doesn't have the trust of the market, but the church does. And so if you can leverage that, then the insurance company can piggyback on the trust that the church has. This is an example in India. Max Vijay is a low-income brand for Max New York Life. So in India, the insurance industry opened up about 10 years ago to private insurers. Before that, it was all state-controlled. And when they opened it up, they allowed for foreign insurers to come into the market, but only on a joint venture basis. So all of the Indian insurance companies have these two names. So this one's Max, that's the Indian name, and New York Life is, the insurance company name. So what they did in trying to serve the low-income market is said, where can we reach them best? And what they're doing is distributing through these small mom-and-pop type shops, places where in your local neighborhood you're going to go and buy your rice and your curry powder and your bread, and you're also going to get your cell phone minutes topped up. And these have regular foot traffic. Well, now you can also buy your insurance there. And the key to this is really easy access, so it's near where people live, but the product design is also one of the very interesting things. So there's an initial payment of 1,000 rupees, which is a fairly big investment, so that's one of the barriers because of this initial investment requirement, but then the policy doesn't lapse. And that's one of the problems with endowment products for low-income households is, with the regular type of product, when you pay your premiums, if you stop paying, the policy lapses, there's very little surrender value, and people basically have wasted their money. So with this one, they've designed it so that it doesn't lapse because they have this initial investment of 1,000 rupees. And then anytime you've got a little bit of extra cash, when you buy your bread, you can take the leftover money from buying that purchase and put it onto your insurance product. They tried this handheld device as a mechanism for doing it, and it took too long. So they gave up on that, and they're basically using the same mechanisms, scratch cards, that they use to top up cell phone minutes. They top up their insurance product in the same way. But this is something that's very convenient for people that they can do very close to their house with somebody that they see regularly. You know, one of the big problems with insurance agents that roam through, I have to be careful with my hands, that roam through the villages, that they've gotten a bad reputation because they're there today, they sell the product, and then they disappear and you don't know when you're going to see them again. Well, these people, they see them every day, and so that helps to overcome this trust challenge that's one of the bigger obstacles. Here's one also in India where they're using these handheld devices to be able to provide telemedicine and insurance out to rural areas. So if there aren't any healthcare clinics immediately available, they've trained village health workers to be able to do some preliminary diagnosis using these handheld devices that link them to doctors, and then they can, if it's a basic issue, they can offer a prescription there, or if they need to phone the doctor, then they can do that as well. So it's a way of extending both the health care and the health insurance out to people who aren't near healthcare facilities. These are all examples in Sri Lanka and India of weather index insurance. It's a way for farmers to be able to manage their agriculture risks, particularly related to either too much rain or too little rain, using index as a way of saying, you know, if the rain is above a certain amount or below a certain amount, then you automatically get a payout. So that way you don't have to go through the claims verification process. It's automatically linked to the weather data, or it could be linked to an area yield data, or it could be linked to a price data. So there's different ways of creating indices that are relevant for this market. This one's having some difficulty in sort of really, it's a very technical field, but also getting people to be able to, it's an expensive type of product. And so it is taking off in India, partly because the government is willing to subsidize some of the premiums. These are examples of index insurance, one with cattle, where usually to identify the animal, they would tag the ear. But then there's lots of animals going around without tags, without ears, sort of the Vincent van Gogh animals. So what they're doing is they're injecting RFID, radio frequency identification devices, into the animals as a way of identifying them. And so that's one where you can't easily take it out. And so it's changed the whole process of identifying the animal. And if that RFID can then be used by the cooperative, for example, for monitoring vaccines or milk production, then the cost of the device ends up being shared for multiple purposes, and then insurance can be much more affordable. And they think that they'll be able to drop their claims experience by 40% just by eliminating the fraud. So there's a huge amount of fraud in livestock claims. This drought-stricken area here is it's in Kenya, and it's an organization, ILRI is the International Livestock Research Institute, and they're experimenting with insurance for livestock, but it's based on satellite imagery of how green the area is. So the satellite imagery gives a feedback to say that it's sufficiently green for feeding the animals, or it's not, and that then triggers the insurance claim. So this is another way of trying to get away from verifying whether there really was a drought, using the satellite technology to be able to show that there's enough fodder for the livestock. So these are the types of innovations that we're supporting, and hope that they'll be able to generate some keen results that will be able to make insurance more available, and better insurance product more available to more low-income people. I want to quickly wrap up with some of these challenges, mostly that I've mentioned already, so it's just summarizing. One is distribution. How do we get insurance to many large number of people, particularly distribution channels that have their trust? Another is thinking about product design. If people can't read policy documents, I can't even read my policy document, to tell you the truth. I've been working on insurance for a while, and it's a complicated thing with all these I have to get on my glasses. And so how do we design products in a way and communicate them so that people really understand what is covered and what's not covered? So there's no problem when there is a claim that people know whether, so the insurer and the claimant both agree. Because one of the problems with this trust is if I think I have a claim and it gets rejected, that's going to completely reinforce the negative perceptions that people had all along. Another key challenge is educating the market and making sure they understand how insurance works. Now there's making insurance tangible. Insurance is essentially a promise. So what can we do to be able to make sure that there is some sort of benefits for people who don't claim, or that they can see the tangibility of it? And part of it is providing benefits in kind, so healthcare itself rather than a reimbursement for their healthcare costs, or providing a funeral service rather than a payout during a death. But also for those people who don't claim, how can they see value? Because one of the big challenges is renewals. People may try it for a year, but if they don't claim, they want their money back. Well, that's not how insurance works. And so you need to show them that there was value for that during the course of the period where they were covered. For example, one of the index insurance in India that I was talking about, they send farmers SMSs telling them the weather. And so that's a way for them to show that there's going to be rain, there's not going to be rain. Giving them information doesn't cost them very much, the SMS to all their policyholders, but it's a way of demonstrating to their policyholders that this is a valuable thing that you want to have. So if you're just paying for the SMS service, it's still valuable. And if some risk happens, well, then you also get the insurance coverage as well. Or healthcare providers, say, giving out mosquito nets, insecticide-treated mosquito nets, is a way of preventing claims, but then people have this tangible thing in their household that helps to reduce claims, but also they can see and it reminds them, this was worth the investment. So those are the ways that we need to think about how to make insurance more tangible for people who don't claim. Maximizing efficiencies. Talking about huge numbers of low-income people, very small premiums, very small claims. How do we make this more efficient? And this is an ongoing challenge, and we think that there's huge potential for technology to be able to contribute to this, but we need to figure out how to make it happen. Certainly reaching huge numbers and keeping them, encouraging claims. Insurers think this is ridiculous when I say this, but the only way we're really going to show people that insurance is going to meet their needs is if they start seeing that there are payouts and the people who have the risks get their whatever they're due, their money or their services. And in fact, we want there to be some early claims in order to show that it's worthwhile so other people start buying the insurance policy. And then lastly, we need to develop appropriate insurance arrangements that are valuable and viable for the poor. That a lot of the different models we've talked about, community-based models, BOP-driven approaches from insurance companies, they're all limitations to all these different models. And so we need to think about ways in which we can piece together different players to be able to more effectively serve low-income households. So with that, I want to thank you for your patience, for your interest, and it was great talking with you.
The trust issue is very important. You're absolutely right about that. And I'd like you to say a few more words, please, about the regulatory scenario, because poor people need to trust that their money will be kept for the purpose it's intended, and regulation will play a key part in that.
I'd say this is early days. That the regulator perspective right now is what can we think about in terms of agent licensing? How can we lower the threshold so that you don't have to have 100 hours of training in order to do microinsurance, because we're talking about very simple products. So maybe you could be a lighter touch on the licensing side. They're looking at who can be licensed as an agent, issues around product design in terms of reporting and simplification, a lot of the reporting requirements that are provided, and trying to find ways of simplifying that to make microinsurance possible. So it's much more at the stage of enabling the availability of insurance to the poor. I think the next wave of discussions, and it's starting to happen now, is really what can the regulators do in terms of market conduct and be able to make sure that the poor realize that they have grievance mechanisms, that if there is a mis-selling going on, they know how to go about complaining about that, and so forth. So I'd say the one country where this has happened the most, and the level of discourse around this is most sophisticated, is South Africa. And one of the things that's really interesting there is that the more you get involved in market conduct regulation and start saying, well, in fact, you need to not provide advice, because if you provide advice, you have to be particularly licensed. So they've created this other option of this sort of tick box saying, yeah, I've read the rules and I understand, and yes, I do want the insurance. And so by moving away from sort of an advice-based to more of a tick box based, it certainly streamlines it and makes it possible for retailers to be able to sell insurance, for example, without being educated on how to sell insurance. But the problem then is there's a lot of people who don't actually know that they're covered. So you see a lot of these mandatory products in particular, where if I buy furniture, somewhere in my credit terms and conditions, I ticked a box saying, yes, I also want insurance, then I've got coverage, but I don't know that I have coverage because I didn't actually read it, or I don't know how to read. And so you have very low claims ratios, and you've got insurers that are making a lot of money off low-income people. And this is one of the things that we are certainly concerned about and want to try to find ways of addressing. So it's a challenge to try to find the right balance between trying to create an enabling environment and encouraging distribution while making sure that we're protecting the consumers at the same time. So stay tuned. There's no definite resolutions to this, and then I think there'll be a fair amount of experimentation as the discussions around consumer protection and microinsurance start getting hotter. Most of the discussions now, I said, are much more focused on product design and encouraging insurers to go to market, and now we need to sort of come at it from the other side, from the market conduct perspective.
I just wondered if you could expand a little bit more on examples of these public-private partnerships. You mentioned one example where the Indian government is subsidizing premiums, but maybe you can enlighten us on other examples there. Thank you.
So this is one in Kenya, and it's actually not a super story as far as the success is concerned, but it's a story of be careful about public-private partnerships. It's a warning story. So this is an insurance company, cooperative insurance company, actually Bert was there just recently, in Kenya, that is providing a composite product through SACCOs and MFIs to low-income households outside of the formal sector in particular. And one of the benefits is this National Hospitalization Insurance Fund. I think it's hospitalization, not health, but anyway, or maybe they've just changed it because of this issue. So they've been trying to find ways of providing this composite product that includes risk that's carried by NHIF and CIC's own personal accident type cover, including funeral expenses. And recently the government said, you know what, we're going to move away from just hospitalization, which is what it's been an inpatient benefit. We're going to provide more universal health care coverage, which is great from a health perspective, but that increased the cost of the premium by 50%. And CIC was already having difficulty getting big take-up on this product. So on the one hand, they like the idea of providing outpatient cover to their policyholders as well. But on the other hand, so there's also issues related to the quality of care and whether NHIF reimburses on time. So there's definitely service quality concerns that related to working with the government. But now the fact that they are required to provide this outpatient benefit as well is increasing the premium more than the target market can afford to pay. So it's a cautionary tale of collaboration with the government. I do have another example in India, which is just getting started right now. So in India, they have a similar thing with a hospitalization benefit provided to BPL populations below the poverty line. These are people who get a specific card to be able to say that they are BPL. And they have then access to this hospitalization insurance benefit that is provided by the government, but managed by insurance companies. So that's the first sort of link with public-private partnerships, is that the government is carrying the risk, and the insurance companies are essentially managing the product on their behalf, distributing it. The government's not managing the risk. The government's paying the premium. The insurance companies are managing the risk. And now one of the interesting developments with one of them is to testing a voluntary outpatient product that they would add to it as well, so that people could then also be able to get the pharmacy subscriptions filled and see their family doctor. So we think that from a health perspective, again, that's going to generate huge benefits, because people won't wait until they absolutely have to be hospitalized in order to seek health care, because that's sort of what the incentives that you're creating if you only have an inpatient approach, is that people don't go early and seek early treatment, but they wait until they have to be hospitalized, because that's what's covered. So seeing if we can find ways of providing outpatient coverage through this public-private partnership with ICICI Lombard.
In the beginning, you showed us so in Africa, most of the insurance are related to persons, and farming and home insurance are nearly not existing. Is this proportion the same in Asia? Do you have any idea about it?
As far as home property insurance coverage is concerned, in India, there's a few examples of these composite products that will have an inpatient hospitalization benefit, a funeral cover, and what they call hut insurance. So if the house burns down or is destroyed in a disaster, that they would reimburse those costs. But not on a huge scale. And in Latin America, there's a few experimentations going on with regard to disaster-related coverage for properties. But again, it's much more on the experimental side. Part of the problem with the property insurance is on the claim side. So first identifying the property, and then being able to go out and verify that the insured event occurred. And so Holler, the one I mentioned in South Africa that is experimenting with property insurance for houses, is experimenting with these sort of informal claims runners. So it's not just about distribution, but it's also about claims verification. So that they sort of hired and trained an army of people who are much low cost than their usual claims assessors to be able to go and use cell phones, take pictures of what's happened, and then forward those photos back to the real claims assessor. So it's a way of trying to innovate around the insurance model to be able to provide the information you need to make a decision, but do it in a different way in order to make it more cost effective for the market. And we think that some of these innovations, in fact, many of these innovations, it may end up benefiting the insurance industry in general. That if they can figure out how to make these things work in the low-income market, that then they can say, oh, maybe we can apply those same innovations to our mainstream products and be able to lower costs. In fact, when you talk to Zurich about why are they interested in microinsurance, that's one of the main reasons that you hear about. Yes, it helps them to access to new markets, but we also think we can benefit from learning about operating in those new markets will benefit our core business to begin with. The other related part of that question was agriculture insurance. And the only place where we've seen this index insurance go to large scale, 200, 300, 400,000 people covered, has been in India because of the premium subsidies. Other places you find lots of small pilots of a couple hundred here, a couple thousand there. But when you're talking about premiums that are around 10%, 8-10% of the sum insured, that's just a big expense to add on to a farmer's sort of expenses. So one of the innovations that are interesting is maybe you don't pay for the losses, but maybe you just provide seed next year. And so where the seed companies or the fertilizer companies are getting involved, then they're providing in-kind benefits that, if you took the seed on a loan, or if you bought it on credit, then you don't have to pay off your credit if the risk occurs, and we give you the seed next year. So it's a way of maintaining customer loyalty and providing a tangible benefit that enables the farmers to at least next year get started again. Not perfect, but it's a way of trying to find some innovations around making this possible for low-income households.
So, ladies and gentlemen, I have the pleasure of making some closing remarks to this third edition of the Microfinance Lunch Break, which today dealt with the subject of microinsurance. Mr. Craig Churchill, an eminent specialist on microinsurance, led us to a series of items such as why do poor people in developing countries need insurance? How do their insurance needs differ from formal insurance? Is microinsurance financially sustainable? and what are the main challenges the microinsurance industry faces. As a very experienced watcher and player in the world of microinsurance, Mr. Churchill gave us a bird's eye view, very quick, on several of these issues dealing with innovating risk coping mechanisms. I'm sure that he left us with a lot of food for thought. The aim of the Microfinance Lunch Breaks is to raise the awareness and to increase the interest for the challenging world of microfinance and microinsurance. Today, we went already through the third edition, and as a lot of you can state, there is an increasing interest for the subject. As promised, we will alternate the subject between microfinance and microinsurance. We were glad that, as of this session, Assuralia joined us as a partner for the Microfinance and Microinsurance Lunch Breaks. BRS is convinced that with ADA, Fabelfin, Assuralia, KBC and SERA, we have strong partners who are convinced on the important role microfinance and microinsurance plays and has to play in the future and are willing to support this initiative very actively. Although with some reservation, I can inform you that the next Microfinance Lunch Break is scheduled for February 2011 with Jonathan Murdoch, Professor of Public Policy and Economics at New York University and co-author of The Economics of Microfinance and another book, Portfolios of the Poor, How the World's Poor Live on $2 a Day. So, many thanks to Mr. Craig Churchill for his clear and concise introduction today. Many thanks also to you for your presence in large numbers, which is an encouragement for all those involved in the Microfinance Lunch Breaks. And last but not least, many thanks to KBC, who gave us the opportunity to gather here in their splendid premises at the Brussels Grand Place. Thank you.